Welcome back to Newsfeed PM. Let's give you some business news now. Property group Redefine, which owns malls like Maponya Mall and Pan Mall in Alexandra, has reported solid results for the year ending in August. Now, headline earnings at the firm were up close to 60% over the period. Revenue increased by 7.5% to 10.6 billion rand. This was higher than the 9.9 billion it recorded last year. Now, despite those good numbers, the Real Estate Investment Trust, with a portfolio of around 100 billion rand in South Africa and Poland, also posted lower attributable income and weaker dividends per share for the full year ended in August. Joining me now for the firm's performance is Redefine CEO Andrew Konig. Andrew, looking at this particular past period, some mixed results there. What was specifically difficult about operating in the period?
Good evening, Motheo. I think, Motheo, the biggest challenge for us during this period has been dealing with the elevated interest rates that have obviously impacted upon Redefine's overall earnings for the period. Having said that, I think the worst is over for us. Having absorbed the full year of high interest rates, I think we're now going into a rate cutting cycle, which is going to bring some relief to that line.
Now, you have a strong retail portfolio, which includes shopping complexes like Maponya Mall and Pan Mall in Alexandra. That's a lot of foot traffic. What are your anchor tenants saying about the business environment? Are they surviving?
Motheo, it would seem that the retailers are doing quite well. I think, disposable income seems to have improved. I think consumers generally are feeling a little bit more positive about the future with interest rate relief on the horizon. As a consequence, I think retailers are benefiting. I think the two-pot system, similarly, although it might be a once-off, is also starting to translate into additional retail spend.
We've seen retailers do well, but some in the industry have suffered, the likes of Game having store closures, Pick n Pay also planning store closures, cinema houses like Ster-Kinekor also reducing some of their business. Is that going to affect some of your property portfolios?
Motheo, it will to some extent, but it's a very limited extent. Over the years, we've been reducing exposure to tenants such as the ones you've mentioned. And we're working very closely with Pick n Pay in a partnership to reduce store sizes where, historically they've had back-of-house storage facilities which no longer are required. And there is one store closure that we've got in mind, but nothing significant.
We've seen the South African Reserve Bank start its interest rate cutting cycle. Earlier on, you spoke about how those higher interest rates have hit the business. The commercial property sector, how are they going about surviving through these higher interest rates, and how are you keeping the occupancy rate up at the company?
So, Motheo, the issue around management of our debt is something that we are very close to. And then we take out interest rate swaps to manage the debt burden from an interest rate cost point of view, where we try to flatten out the interest rate impacts through derivatives. So we don't necessarily see the benefit of the lower interest rates fully, in that we are about 80% hedged. So our debt, from an interest rate perspective, is fixed. But we do watch very carefully our interest cover ratio, which is a key indicator of the company's ability to service its interest rate obligations. That for us, Motheo, is probably more important than the interest rate itself. And we manage that as closely as possible through a program of recycling assets that means to sell non-core assets and then to deploy that back into assets that have got good growth prospects going forward.
And Andrew, when do you expect things to turn around completely for the sector? We've had higher interest rates are now going lower, expected to be even lower in 2025. When do you expect the industry to be back to health, if you will?
So I think, Motheo, the short answer is that we're well on the road now to return to where we were before the pandemic, i.e. back to the health we speak about, because confidence brought about through the lower political risk, load shedding having ceased since 26th of March, and even progress on the economic reform front, driving that confidence that is translating into property fundamentals improving. And with that now, you're getting interest rate reductions. So the two working in tandem, confidence and the interest rate relief, will drive the property sector cycle back upwards. But it will be gradual, Motheo, because I don't think the Reserve Bank's in any hurry to dramatically reduce interest rates like they increase them. It will be a gradual process. So we see this as a 12 to 24-month journey going forward, but steady but slowly upward in terms of improvement.
Are you as confident about your Poland unit?
Probably more so, Motheo, and I'll tell you why. It's because they've got a head start on South Africa in terms of economic growth. The Polish economy is expected to grow by about 3% this calendar year. And if you just look at the condition of the man in the street from a funding point of view, from a debt obligation point of view, very low levels of personal debt. Inflation is under control. Disposable income is rising. Everybody's got a job. They've got a very high level of employment. Roughly 5% are unemployed, which means basically everyone has a job. And you are still seeing, stability creeping in through social support as well, in terms of social grants and so forth. So disposable income on the up. We've seen it in retail sales there similarly. So a very different story to South Africa in terms of the underlying fundamentals that are supportive of retail recovery in that market.
Andrew, thank you so much for your time. Redefine CEO there, Andrew Konig, talking about the company's mixed results, saying those higher interest rates are still hitting the property sector.